How you doing, everybody? My name is Justin Macari. I'm the founder and owner of Mac Tax CPA. We're a tax and accounting firm, CPA firm in Comac, right here in Long Island, not too far from here. What are we? I got an about screen in a second. So just what we do briefly: tax compliance, business and personal tax returns, tax planning. A lot of people with varying income, high net worth income. Anybody who's taking their taxes seriously, planning is a great aspect to do with your CPA. My goal of today is to give you guys a bunch of action items to take, whether you do it yourself or you have an accountant you're happy with, to go home and ask them a few key questions to try and save yourself a few thousands, hopefully tens of thousands of dollars, and at least get a plan for the future, because looking ahead, taxes are one of the most biggest expenses that we pay. We have a specialization in business taxes, R&D taxes. We deal in digital assets, cryptocurrency, when people get involved in sending digital assets to multiple wallets. That's a specialized we have. And CFO services for small business and medium-sized businesses. We get on a call, go over margins, go over their financials, help them make better decisions to run their business more profitably, and deal with all the issues that come up with being a business owner. So who am I? Why should you listen to me? I got my MBA at Delphi University. I was just chatting with this gentleman before. He lives in Garden City, one of my favorite towns. I worked with high net worth individuals while I was in college. I was an intern working at Bessemer Trust, FLSV, working on high net worth individuals. I left and started my career at PwC. We worked on medium to large businesses, well, doing up to 500 million in revenue, multiple state filings. They had foreign businesses overseas, so I got great experience during that time. When I started my business, it was COVID, it was 2020, and I walked into a cafe in my town, and it was May or April. It just got done with tax season, was working from home, everyone's in masks, gloves, no one knows what's going on. And I don't know what made me say this to them. I said, this is probably the worst time in probably history to open a cafe. If you guys need any accounting or tax help, let me know. And the owner said to me, wow, it's actually really great. I have these two other businesses that I haven't filed taxes for in 10 years. So that was my first client. That's another specialty we do, is back taxes. Usually people are owed money in that situation. If they haven't contacted you, don't think you're getting away with something. You're probably owed thousands of dollars from the IRS. So we helped them out, they referred us clients. I got my income up to like half of what I was making at the time, and I took the leap of faith. I went full-time with my business in 2021, and we've been growing since. I got a team of 8 guys working for me. We're very focused on the why and the how, and actually delivering value to the client, making sure people understand their taxes. It's one of our biggest expenses that we pay, and if there's certain moves we can make that align with what we're trying to do, and that's going to be a key thing I come back to. Everyone's life is different, so there's no crystal magic answer. That you'll hear things on Instagram. If you could do this Roth conversion and save $80,000 and pay no tax and make $3 million a year. There's a lot of nonsense out there, so we take a lot of pride in taking the time with clients so they understand how and why their taxes are the way they are, and what they could do to change it based on what they got going on in their lives and their businesses. So I'll run through this today. I have a lot of time set aside at the end for Q&A. I want you guys to be engaged. If you have a question that you think is relevant to everyone else, feel free to ask it. And then I'm happy to go deeper on a one-on-one basis with each of you afterwards for anything super specific that you want to discuss. The biggest thing I see it online all the time, social media, Roth conversions. We constantly hear about all these billionaires that have PayPal stock and all this other in Roth, and they pay no taxes. Roth conversions make sense for sometimes for some people in situations, and other times they don't. There's a way to strategize it and use the tax code to your advantage. So when does a Roth make sense? Generally when your income is lower, when you expect to have higher taxes in later years. So if you had a year where you sold a business for a loss, or you had some catastrophic event where you had a disaster loss, or you lost a big investment, you got scammed, your income might be lower that year, that's a good year to consider a Roth. I was just talking to the gentleman prior to this. If you have a lot of money in traditional retirement accounts and you retire early at 60, between 60 and when you guys start drawing those RMDs in your 70s, you could start doing some Roth conversions and diversify yourself out of only traditional accounts into Roth. When it does not make sense, when you're already in a high tax bracket, I got great financial advisors in here who would not, if you're in a high tax bracket in New York and you're paying close to 40%, you could put 30K in and get a 40% instant return. It's a pretty good deal. So when you're in a high tax bracket, the traditional becomes more and more attractive. The Roth conversion as well is phantom income. If you convert 100,000 and you're in a 20% bracket, you're paying $20,000 of tax on money you don't have right now, but you're betting on the long term. You're betting on later, you're gonna be in a higher bracket, or your RMDs are gonna be so high that this is a move that makes sense. You wanna be strategizing and being thoughtful about this. I see a ton of influencers pushing this on social media, if anyone follows any tax content people online. The other thing about Roth conversions is, and backdoor Roths in general, you gotta be cognizant of the income levels. A lot of people wanna contribute to their Roth IRA, and if you're over 150 single and 236 married, you gotta do what's called the backdoor Roth. These guys are experts, they can help you with it. Sounds like really fancy. All it is you put the money in a traditional IRA first, it's non-deductible, and then you convert it immediately into a Roth. That allows you to get around the income limit on the Roth. So if you're a high income earner and you're already maxing out your 401k and your employer does not have a Roth option, you can do the backdoor Roth IRA and get money into your Roth every single year. There's a lot of other scenarios where a Roth makes sense if you have kids on payroll, low tax brackets, things like that. So, I'm a big fan of the Roth. It's a constant debate. One last thing on the Roth, just to prove that it's not, it really depends on your situation. I had AI do an analysis on Roth versus traditional, high earner, making $200,000, paying 30% taxes, male, lives to 77 years old, takes 4 years of RMD, dies, passes the Roth on to their kids. That's a big thing about the Roth. It's tax-free to the person who inherits it. So that's a very attractive scenario for the Roth. The Roth, in this scenario, if you invested the money you saved from traditional, did 1% better. The Roth did 1% better than the traditional, but they were both in the sum of 30 million after taxes. So it really depends on your situation, and given where your taxes are moving in the current year, you can max out one bucket or the other. Any questions on the Roth?
Can somebody do the Roth conversion after the age of 73? Or after the RMD, when RMD is to be taken out?
You can, yes.
Okay.
All right, so what are some changes with the tax law? They locked in 37% top bracket. That's not changing. That used to be sunsetting. They range from 10 to 37%. It used to be as high as 40%. And us in New York, we're getting close to 50% when you add in New York or New York City, if anyone's New York City residents. These are your standard deductions. $32,000 for married filing joint, $16,000 for single, $24,000 for head of household. A good strategy to make sure you're itemizing if you're a married couple, because they increased the SALT limit, is staggering your itemized years with your standard deduction years. You can strategize your property taxes and your charity to pay it in every other year, so you're maximizing your itemized, and then you're taking the standard in those other years. Is a strategy for married filing joint earners with that high standard deduction. I was just touching on this a little bit. The SALT deduction has been increased. We used to be capped at $10,000 here in New York. If anyone here owns a house, property taxes alone are probably more than 10K already. Now you get up to 40,000 of state and local taxes if you make under $500,000 a year. I also see you taking a lot of pictures. I'm happy to share this with you after if you find this helpful.
Yeah.
This way you don't have to keep it.
Yeah.
I don't want your arms getting tired either. So you're able to write off 40,000, plus you get your mortgage interest, plus charity, plus medical if it's over 7.5%. So what I just did personally, like I've been recommending this to my clients, is I just had my mortgage company close out my escrow account. I said, I want to handle when I pay my property taxes. So I'm going to double up and pay property taxes in every other odd year, I'm gonna pay 2 years at once. So this year when they send the bill, I'm gonna pay it in January, and then next year when I get the bill, I'm gonna pay the whole year in December. So I get a higher property tax deduction, I get my state income taxes, and my mortgage interest. So I'm maximizing my itemized in an odd year, and in an even year, I'm taking the standard deduction. That's a very applicable scenario for a lot of people.
This particular, this thing, the SON, which has increased, is this for 2025? Is it for?
This happened in 25, and this is the plan going forward.
So that means for when I'm going to file the 2026 returns, it was only for 2026 returns, not for 2025 returns, correct?
This was 2025.
It was 2025 returns?
Yes. So Lawrence touched on it earlier, tips and overtime. If you are in an industry where you receive tips or you have overtime, you can get up to a $25,000 deduction on your tip income, $12,500 overtime if you're single, and $25,000 overtime if you're married. So for our married couples in the room where the one taxpayer works and gets overtime and the spouse doesn't work, they can still get $25,000, which is a very nice scenario. These are limited by single and AGI limits of $150,000 and $300,000. We talked also about Social Security. No tax on Social Security. What does that really mean in reality? If you're a senior over 65, you get an extra $6,000 reduction, as long as you are below $75K for single and $150K married, so up to $12,000. This helps reduce the burden because once you're over roughly $44,000 married, 85% of your Social Security is subject to tax. So this reduces that burden. And you get, even if they're not even getting Social Security, they get this $6,000 extra deduction if you're over the age 65. Child tax credits have been bumped up from $2,000 to $2,200. They're also more refundable. Nothing really much to do there. Just make sure you're putting your kids on your return. They'll save you some money. Trump accounts.
Just what's the age that the kids are?
18.
18. Does it phase out like 16?
No, it does not phase out. So the question was, does the child tax credit phase out? The child tax credit phases out at income levels of $200,000 for single and $400,000 married.
Okay, not the age.
So there are these new things called Trump accounts. If your kid was born between 2025 and 2028, they're getting a free $1,000 from the government. There's also this other thing from Michael Dell. If you're inserting zip codes where the median income's below $150,000, Michael Dell's putting $250 in the kid's account. This is a great vehicle for gifting money to your kids. Each kid can receive up to $5,000 into the account every year. And for any employers in the room, you can put, say you have an employee who has a kid or a grandkid, you can put $2,500. The employer gets a deduction, and it's tax-free money to the employee and the child. They can put it directly into the Trump account. So that's a nice little fringe benefit that employers can offer to their employees.
That has nothing to do with 529.
This has nothing to do with a 529. This is in addition to a 529, and when the child turns 18 years old, the Trump account turns into a regular traditional IRA for the child that they have full control and access over. 529s, you knew where I was going next. So 529s have been updated as well. Funds can now be used for trade schools, which is very important in the world of AI. Taking all the white collar jobs, we're going to need more trades. So 529s have more use for trade schools, K through 12, and they can even use to be paying down student loans, which is very helpful. The estate and gift tax has been updated to fit. Everyone has $15 million that they can pass on without paying gift and estate tax. Yes.
Sorry, the 529. Is that still a max of 10,000 a year
Yes. For K through 12.
per child?
You can put up to $10,000 into it and get a New York State tax deduction. There's no federal tax deduction.
Right.
The New York State tax deduction is capped at $10,000 for married couples. You can put up to the annual gift tax exclusion amount into a 529. If you're over that amount, you have to file a gift tax return. There's no taxes due, but you have to file a gift tax return, which leads into these numbers. Everybody gets 15 million per person, so
But just on that, so tell me on that, so you can put into it like 19,000 as gift tax?
that's the annual gift tax
So you
exclusion.
put 19,000.
Per person.
Only 10,000 would be state tax deductible. So you can put more than the 10,000 and you're not getting the state tax deduction. And if you go over 19,000, you have to file a gift tax return. It doesn't mean you pay any tax, it just means they wanna know that you gave some money away. And so you don't eat into your $15 million in the past when you're done, which would cover that.
And that's per kid, per child or per child.
Yeah, you can gift up to 19,000, I believe, is the annual exclusion per individual. So if you're married, you and your spouse can put 19,000 each into the account. There's also a super funding rule where you can front load 5 years of 529 contributions at once. But if you're in a high income earning bracket, it's good to spread those over the years to get the $10,000 state deduction.
Excuse me, so if they fund for 5 years in advance, they will still get only $10,000 and that's it, and not anything for the rest of the years?
That's correct. If you front load it and fund it 5 years, you still have to file a gift tax return, you're only getting $10,000.
Thank you.
So gift tax return, estate taxes, you can gift and pass on to your children or whoever's inheriting your money and assets up to 15 million per person. New York State is a lot lower, it's 7 million. So this really is more of a New York State issue now than it is a federal issue. The federal, I'm gonna pick on the guys, if we die first and the wife inherits all the money, she gets the 15 million. In New York State, you do not get it. So that's where you gotta work with your attorneys to set up an estate planning bypass trust or some other vehicle to do estate tax planning, because the New York State 7 million, unlike federal, it's not portable. But these were set to go lower, so these have been expanded under the One Big Beautiful Bill. Okay, so.
Here we go.
You know what we're talking about here?
Yeah.
So this is a popular topic. Glad you told me to add this in here. So what is IRMAA? This is the government saying you made a lot of money, so you gotta pay more money into the healthcare system. And it is a clip. I got a nice little illustration here. Basically, they look at your income from 2 years prior, and they apply that to your 2026 Medicare premiums. So this is the way it works in terms of your income bracket. So it goes all the way up to 500,000. And if you're in the highest bracket, you're going to be paying an additional $690 a month towards your Medicare. So this is always getting updated and recalculated as you earn more, and they're looking back 2 years to calculate your current year's Medicare premium.
What is the full form of IRMAA?
I'm sorry?
What does it stand? IRMAA means, what is the full form of that? I know that that's an acronym.
What is the full acronym? Income-related monthly adjustment amount. It is a progressive surcharge on your Medicare Part B and D prescriptions.
So just 2 years before you qualify for Medicare, you said? Okay.
Well, they always are looking at 2 years prior. So if you're in Medicare, they're always looking at 2 years prior to calculate your IRMAA.
So Justin, if you're 60, if you're collecting it, you retire, you're on Medicare at 65, you're looking back to 63 to see what you're earning a year?
That's correct. And I have
If you were working, you would be then affected by earnings.
yeah, and what happens in a scenario where the question was you were still working and now you're gonna get hit with this surcharge? What if you sold your business? What if you had a big cash out and you had a big bonus at the end of the year? That could spike your earnings. So this is something where in doing a planning scenario, you wanna be cognizant and putting money aside for this type of a scenario. Also, too, capital gains can trigger it. 63, you just said 63. I have that right here on my slide. That's when they start to look at this. So you really want to be cognizant of what you're earning that year. Look, at the end of the day, if your employer is going to pay you $1 million, don't say no to it for the IRMAA. But this is something too, when we start setting money aside and we start planning for the future, this is an additional cost that we have to factor in. It will drop off in the next year, because it's always a 2 year look back where they're recalculating this. but it's a very progressive surcharge that they calculate that is income based.
So it's not forever.
It's not forever. So if you have a killer year, it's only 1 year where you're gonna be paying.
But if you retire at 62, then you're gonna only be getting a pension or social security, so you're gonna be a lower bracket.
That's correct. So there is a way to strategize.
When does this look back start? In
Uh,
other words,
60
if you retire-
65, they're looking at 63. That's
so
when everyone's
so
back.
if you retire at 60?
Well, this is when you become eligible for Medicare.
So, I'm sorry, what about like, should you put like a lot of money in an HSA if it doesn't expire?
Well, an HSA is always a great vehicle. An HSA is one of the, because medical expenses you can only deduct if it's over 7.5% of your income when you're itemized. However, if you put money in an HSA, if you're in an eligible health plan that allows you to contribute to an HSA, that's always a great move because you get the ability to write off the money when you put it into that bank account regardless of when you pay for those medical expenses. And most of us are all going to spend that money at the doctor at some point. So that's always a great move to do if you have access to do it. Individuals, W-2 earners, where they really don't have too many other deductions, where there's no business, there's no charity, there's no mortgage interest, there's no property taxes. An HSA is a great way to save $4,000 to $8,000 if it's a family plan. So actionable items, strategic Roth conversions, we talked about that earlier. Qualified charitable distributions, if you're in a scenario where you have high RMDs, you can do a qualified charitable distribution where you essentially say, I'm not taking the money, it's going straight to charity. You get a charity deduction that comes right off the top of your income. Tax loss harvesting on your capital gains, making sure if you're gonna get hit with a high capital gain and you have 5 other stocks that are losers, or maybe your kid told you to buy this stock, it's going to the moon and went nowhere, sell that in a year where you have a lot of gains to offset those two, because capital losses offset capital gains dollar for dollar, and they carry forward as well. And then just general planning on distributions of when you're gonna start taking the money, Social Security, when you start drawing on your pension, things like that. So there are certain exceptions. There's a form you could fill out to try and say it was a life-changing event where you had to take some money out. Pushing yourself into a higher tier or selling stocks, not always, just because you've got some, these are the qualifying events. Work stoppage, retirement, so that I wouldn't bank on this. Work reduction, divorce, death of a spouse, loss of pension income, loss of income producing property. You really don't want to be in a situation where you're asking the government for an exemption, in my opinion. You want to just be a little bit thoughtful and plan ahead. But there is an option to try and get it lowered if you fall into certain qualifying events. Does anyone in here, by show of hands, have a business? I'll keep the business
You could rush this.
super brief. If you're thinking of opening a business, they've kept the immediate write-off. If you're thinking of opening a business, you can write the equipment off 100% for federal tax purposes. If you're thinking of doing something very innovative, there's a much greater expanded R&D tax credit. We specialize in this. You get immediate expensing, and if your company that you start is not profitable, the R&D can offset payroll costs. Business interest, you can write off more of business interest under the new tax law. The QBI, business profits, get a special 20% deduction. So if you're thinking of opening a business and you're profitable, those profits are actually taxed at a lower rate thanks to the renewal of this code section. Section 179, we always hear about this, you buy a car, you get 100% write-off. This is back as well. If you have a business that's profitable and you buy a vehicle or a truck over 6,000 pounds and your company is profitable for the year, you get an immediate 100% write-off. This may be applicable if you're looking at certain investments. This is very new, never seen before. You can write off a manufacturing building if it's domestic manufacturing in the United States. That is, I've never seen something like that. Usually it's 27.5 years to 39 years. You have to write off a building if anyone in here owns real estate. But this is 100% depreciation of a building if it's used for qualified manufacturing. I imagine there's going to be investment opportunities where individuals can participate and get a quick write-off or something like this. Opportunity zones extended. Think of opportunity zones as a like-kind exchange. If you own real estate, you're able to sell property, and if you use those proceeds to reinvest in a qualified opportunity zone, which are generally areas that need a little economic spruce, then you may be able to defer or possibly totally eliminate your capital gain. I know we were talking earlier about ways to eliminate capital gains. There's a lot of creative investment products out there that money managers and financial advisors now have access to reduce concentrated positions, to smooth or maybe eliminate capital gains. This is another area to do something like that.
Justin, does that have to be a business property, or that could be if you had a vacation home, you sold it, and you want to roll the gains into the opposite?
This is something where you could do, I believe you can do something like that, where any capital gains could qualify for something like this.
Right.
The idea is to get people out of, say, NVIDIA, and I'll double check this, get you out of a stock like NVIDIA where you may be up 1,000x, and buy property in an area that really needs the investment. Incentivize it by allowing you to defer that capital gain, and if you hold it in that area for a certain amount of time, eliminate the capital gain. If anybody does any side business work, the 1099-K threshold's been increased to 20,000. So if you get Venmos from people, that's gone up to 20,000 in terms of having to look for a tax document, or if you sell stuff on eBay. And for any employers in the room or freelancers, it used to be $600. You had to give someone a 1099, or you would receive a 1099. That has now been changed to 2,000, and that's now indexed for inflation. International rules have changed. No one here has a business, but that's something we specialize in, is U.S. companies that have international businesses overseas. That's my spiel. Does anyone have any questions? Anything applicable in your life that is a planning opportunity?
We'll talk about that, but my daughter's turning 18 this year, so that's what happens after as far as her age, for the tax trial. Right?
Yeah, so this would be the last year that you're gonna get.
I guess that this year I get it this year for her though.
Yeah, and then she'll probably go to being an independent on her own tax return.
I don't know what they do.
No problem. Thanks, everybody.
Justin, thank you very much.